So here's my bold prediction for the next 12 to 24 months. The era of relying solely on wealthy, accredited angel investors or massive institutional venture capital rounds to scale a small business is really ending if it's not already dead. Unless you're a high growth, AI driven, Silicon Valley style tech startup, the future of capital, in my opinion, is much more ecosystem driven. And this is a fundamental shift. Now we're talking about having your most loyal supporters, your brand advocates, members of your local community network. These are the people that are going to become your primary financial backers. If we haven't met before, my name is Maritza Shay Nelson, and my mission is to help entrepreneurs, founders, dreamers, and innovators pursue their passion without worrying that all the legal stuff might come back to bite them. Today's video isn't about legal technicalities. As an attorney, I love to nerd out on some of the details, but sometimes we just need to talk strategy. And so today we're looking at how raising seed funding, those initial dollars to get things started or to grow the business and take it to the next level, that's changing and what that trend means for your legal structure right now. Here's the fundamental reality. While the goal used to be doing some seed funding, we've talked this month a lot about using convertible notes or safes and eventually getting to that Series A and raising venture capital dollars. Most of the entrepreneurs, the dreamers, the founders, the innovators, the people that I talk to and work with, they're not looking to eventually sell to venture capital and lose a huge chunk of their company. They want to retain ownership and control. They're building something that they're personally invested in. They're looking at this more about, what's the long term look like, not how quickly can I scale up and sell out and start something else. And there's nothing wrong with that if that's your goal and you're in that tech startup, AI, startup kind of space. It's just not what the vast majority of small businesses are doing. And even when, these founders, the dreamers, the innovators, the entrepreneurs, the people like you do finally decide, okay, now I'm ready to think about exiting. The friends, the family, those community members, the people in their network, those folks that supported you from day one want to share in that success. And none of you, right, from the founder down to, dear Aunt so and so who's supported you and helped you out, none of you are looking to be beholden to corporate overlords, red tape, venture capital telling you, hey, gut the core of your service model and focus on how quickly can we, earn more profits. How fast can we hurt our customers? How much can we make them tolerate? Nobody's looking to become that corporate. However, most of your traditional big corporate law firms are only interested in those high growth tech startups because, that's where the billable hours are. They're looking for those folks that are chasing that Series A, or they're working directly for those venture capital folks and telling you, hey, these are our standard documents. Just sign whatever we put in front of you. Um, they're interested in those really expensive Regulation D private placements, hundreds of pages, tons of billable hours. We're chasing after high net worth individuals, or they're representing those high net worth individuals. And again, there's nothing wrong with that. That's just not the other 80%, right? That's just not the rest of us. So what then does this look like for everybody else? From talking to so many entrepreneurs, this idea of sort of doing more crowdfunding, it can really help more people get access to the capital that they need to get the business off the ground or to take things to that next level. But it also changes, how you go about pitching, how you operate the business, because we're no longer talking about, pitching to a single institutional VC partner. We're not talking about that angel investor who's used to dealing with startups, who's looking at, is this one going to be better than that? Is looking for a certain tech-driven type of operation. We're no longer talking about managing just a handful of those term sheets for a convertible note or a safe. Instead, we're now trying to figure out, okay, how do we manage communications with anywhere from a dozen to potentially hundreds of micro investors? How do we do that in a way that's still legal? Thinking about that, right? That structure, that puts a lot of pressure on just basic business administration and operation. Who gets to vote on what decisions? How much information do we need to disclose to these micro investors? When do we need to disclose it? How much financial transparency is required? And some of that is going to depend on legally what's required, because just because we're talking about micro investors, I'm going to say over and over again, we still have to deal with securities laws and regulations, or look for those exemptions that we've talked about in the past. But it also starts to play into, what are your personal ethics and morals and values when it comes to running those business? How do you want to treat those supporters? And most people I talk to, they're not trying to hide the ball. This isn't about, let me get the money from my micro investors, from my friends and family, and then, just keep them in the dark. So what does that look like, and how do we structure these things? Now, if you've been around a while, if you've watched the channel, if you've been on the website, you know my tagline. My goal has been to be sophisticated legal counsel for serious entrepreneurs. And so when I'm looking at this shift from, your traditional old school cap table to, what's it look like to bring in a community? What's it look like to have this business driven more by your ecosystem and by your network? There's three big concerns that I start to have as legal counsel. And the first is that we have to be way more creative with how we structure your LLC operating agreement or your corporate bylaws and shareholder agreements. We want to minimize the risk of that operational gridlock that I talked about, right? We want to figure out how we're going to deal with decision making, how we're going to deal with communications, but we also don't want to jeopardize, tax status if you are pursuing S corp taxation. We want to keep things simple if you're doing more of a partnership taxation structure, and we want to make sure that everybody understands what that means and what that looks like and what they're getting into. But number two, we have to be careful about the structure, because we still have to be concerned about those securities regulations. What I hear sometimes over and over again is, well, we just won't call them investors. They're just silent partners. Well, newsflash, that is an investor. And just because you don't call it an investor, just because you say, okay, we'll just use a different term, does not at all mean that the law will agree with you. And the last thing we want to have happen is a disgruntled micro investor, small partner, minority partner, whatever you want to call them. They've got some sort of personal grievance, or they're not getting the return that they were hoping for. And then they use that to go to their attorney, who says, oh, I can turn this into a securities fraud case. And then everybody's starting to see dollar signs. And the third thing that I have to worry about is, how do we save room for all of the future possibilities? Yes, you're looking at what I'm calling micro investors right now. These might be friends, family, people in your network, people, second, third degree, that are kind of coming into it. But that doesn't mean that at some point in the future, you might not be interested in a typical commercial bank loan, SBA loan. And we need to make sure that this structure is clean enough that when you go to the bank, that when that goes to underwriting, the bank's not going to say, what's happening here? We don't understand this. There's a bunch of red flags. We've got questions and concerns. We don't want to do this loan. Or your future might be, hey, this is great. I've run this business for 30, 40, 50 years, and now I'm ready to sell. And that's what my exit strategy looks like. Well, again, whoever you're selling to, the buyer and their counsel are going to want to do due diligence. And so we don't want to raise a bunch of red flags with a really messy structure, potentially disgruntled investors, all those things that while you might not be thinking about it today because your goal today is to get to profitability or get to the next level to scale to a certain point, at some point we've got to say, hey, is this clean enough that we'll actually be able to sell it if that's what your exit strategy looks like? So, as legal counsel, my job is to be looking not just at what you're trying to do today, not just at how we get around or through the securities regulations today, but also what does that look like as you're running the company next year or 5 years from now when your investors are like, this is great, you're doing well, we want out. Let's move on, give us our money back with our interest, our preferred returns, whatever that might be. What does it look like when you get to, okay, the next level is bank funding or the next level is selling the business? So it's to be thinking not just about today's legal problems, but also 5, 10, 20, 30 years down the road and how all of this is going to play out. So I'm not saying that a more community driven, more ecosystem approach to building and scaling your business doesn't raise its own questions, right? It does present some creative legal challenges. And I love that kind of work. It's why I like working with, entrepreneurs, founder led companies. But in a world that is so increasingly focused on what's the next shiny thing in tech, who's going to figure out the next thing that AI is doing, in a world where banks don't fund cool ideas, they don't fund well written business plans, where do the dreamers, the innovators, the passion people like you and I turn to fund and build and grow something amazing, if not to their community, to their network? The old saying is your network determines your net worth. So, how do we tap into that in a world where sometimes the law is still stuck in 1995, right? And not 2026, 27, 28, and beyond? And how do we make sure to do that in a way that's going to protect you and what it is that you're building? So, to keep learning, be sure to watch some of my deep dive videos. I've got one about some of the equity traps that we can run into if you're trying to do this but do S corps. So check out that video. It's Stop, Don't Lose Your S corp status with These Equity Mistakes. And if your plans this year include raising money from friends, families, other people in your community and your network, whether by bringing them on as minority owners or through crowdfunding, whether that's actual regulation crowdfunding, or if you're thinking about Kickstarter and you're wondering the difference, then you need legal counsel who understands that small businesses are so much more than whatever venture capital happens to be interested in this week. So head over to msnlawoffice.com/scheduling to schedule a consultation, and I'll see you in the next video.